Welcome to the deep dive.
Mhm.
We are really thrilled to have you with us today. For the last couple of years, we've all been sold this really sunny, utopian upside of artificial intelligence.
Oh, absolutely. The whole frictionless future narrative.
Right. We've been hearing it from salespeople, tech advocates, visionary founders, and they all paint this picture where AI just solves our hardest problems and ushers in this golden age of leisure.
Yeah, but recently, if you've been paying attention to the markets or the broader business world, the cracks are definitely starting to show.
They are. And it brings up a really counterintuitive question. What if the problem we are about to face isn't that AI fails to deliver on its promises?
What if the disaster scenario happens because AI works too well?
Exactly.
It is a fascinating tension to observe right now. I mean, the public narrative is visibly shifting from unbridled optimism to some very real, very tangible economic anxieties.
And the mission of today's deep dive is to cut right through that hype. We are going to figure out exactly how AI might disrupt the global economy, which jobs are actually on the chopping block, and most importantly, how you can prepare yourself for what comes next.
Yeah, and to do this, we are drawing heavily on a brilliant, incredibly thorough breakdown by the renowned financial expert Aswath Damodaran.
But before we get into the meat of that analysis, though, I do have a little bit of housekeeping to share with you. To access more advanced researches, applications, and our latest published personal intelligent multi-agent deep value intelligence, welcome to subscribe on deepvalues.ai and research.deepvalues.ai.
Definitely check that out.
Also, to track total market temperature, welcome to search and download iOS app Buffett Indicator from Apple App Store.
And as a quick disclaimer before we begin, all analysis is based on publicly available sources and may be subject to revisions or differing interpretations. All contents from this channel is for educational and research purposes only and does not constitute investment advice. Conduct your own due diligence before making investment decisions.
And if you'd like to access wider topics, including life and investing philosophy, please subscribe to our sister channel at Deep Values. Don't forget to like this video. Much appreciated.
Always appreciated.
Speaking of deep values, the market is aggressively recalculating the value of AI right now. Okay, let's unpack this. Where exactly did this shift in the AI narrative actually start?
Well, the catalyst really happened during the most recent round of big tech earnings reports. We saw these massive technology companies announce tens of billions of dollars in new ongoing AI investments.
Staggering amounts of money.
Right. Now, if this were a year or maybe a year and a half ago, the market would have thrown a parade. The stock prices would have surged on the sheer promise of innovation.
But this time, they didn't.
No, the market pushed back. Stocks actually went down. Investors are suddenly asking the hard questions about the return on all this capital expenditure, and more importantly, the collateral damage it might cause to the rest of the economy.
Which leads us right to this really jarring report that Damodaran highlights, published by Citrini Research. They didn't just put out a vague, ominous warning about robots taking over.
No, they got highly specific.
They circled a specific date on the calendar, June 30th, 2028, just a couple of years from now.
Yeah, the Citrini AI assessment paints what is essentially a macroeconomic doomsday scenario by that exact date. We are talking about unemployment rising rapidly above 10%. They predict the broader markets will be down 40%.
Wow.
The economy effectively in a state of severe shock and shambles.
But the mind-bending twist here in the Citrini report isn't that AI turns out to be a massive bubble that bursts.
Yeah.
It's not a failure of the tech.
It is the exact opposite. The doomsday is triggered because AI succeeds. It works incredibly well, and it's adopted incredibly fast.
So it's a victim of its own success.
Exactly. The scenario projects that AI replaces highly paid white-collar workers at a blistering pace. We're talking lawyers, mid-level bankers, management consultants.
The people who usually feel perfectly safe from automation.
Yeah. Right. And because those workers lose their jobs so suddenly, they lose their incomes. When a massive swath of the upper middle class loses their income overnight, consumer spending just drops off a cliff.
And that consumption void takes the broader economy down with it.
It is a story of catastrophic success. I mean, we have spent the entire 21st century worshiping at the altar of disruption, but destruction comes with a very real cost to the people working in those disrupted spaces.
Here's where it gets really interesting, because that report clearly hit a nerve on Wall Street. You had Goldman Sachs, Moody's, JP Morgan all jumping into the fray. But the most surprising rebuttal came from Citadel.
Yes, Citadel.
Citadel is a massive hedge fund, and they notoriously avoid wading into these public, speculative business debates. So why do they step in, and how do they dismantle the Citrini doomsday scenario?
Well, Citadel's assessment contests the idea of an overnight economic collapse using three very solid pillars. First, they looked at the current hard data on layoffs.
Which is what everyone should be looking at.
Right. If AI were causing a software employment cliff, you would logically see it in software engineering first, since coding is directly targeted by current AI capabilities. But we haven't seen a cliff. We've seen about a 6% drop in software jobs over the last couple of years.
Only 6%. That's not a cliff at all.
Exactly. Citadel points out that this is much more likely just normal attrition and market correction after a massive period of overhiring during the pandemic.
So the data tells us it's a dip, not a devastation.
Yeah.
What is their second pillar?
History. Citadel looks back at past technological disruptions, like the PC revolution in the 1980s, the dawn of the commercial internet in the late 90s.
Right, those didn't happen overnight either.
They took real agonizing time to integrate into the corporate world. They always move in a pattern of 3 steps forward, 2 steps back. Think about the dot-com boom. You had the initial hype, the massive crash in 2001, and then a slow, grueling decade of actually building the infrastructure that changed the world.
So disruptions never happen in the highly compressed overnight timeline that the Citrini scenario suggests.
They just don't. And that brings us to their third pillar, which is macroeconomics.
How does Citadel justify the math of a massive tech rollout without an economic crash?
Well, when you disrupt an existing business and replace human workflows with a new technology, the driving force for that change is a massive productivity benefit. You are producing more output for less cost.
Makes sense.
Citadel points out that historically we have never seen a major disruption that creates a productivity benefit of this magnitude simultaneously cause the market and the broader economy to suffer as severely as Citrini predicts.
You might have localized short-term adjustments in specific sectors, sure.
Right, but a massive society-wide productivity boom does not historically equal an economic wasteland.
So we have these two massive financial powerhouses completely at odds. One says economic ruin by 2028. The other says it's a slow, manageable, historically normal evolution. Why is it so hard for the smartest, highest-paid people in finance to figure out what will actually happen?
What's fascinating here is that finance and economics have a systemic blind spot when it comes to dealing with true uncertainty. The industry relies heavily on what we call point estimates.
Late estimates.
Yeah, a point estimate is when an analyst makes their best guess on revenue growth, margins, and risk, and then spits out one exact specific number for a company's future value.
But picking one exact number for a future event guarantees you will be wrong.
100% of the time. But people in finance have been historically resistant to adopting probabilistic, statistical approaches, like giving a range of possible outcomes for a few interconnected reasons.
Like what?
In the past, it was simply too computationally expensive to run complex multivariable simulations. Today, obviously, that excuse is gone. A second reason is that many finance professionals are actually quite uncomfortable with deep statistics beyond basic bell curves. But the third, and most powerful reason, is purely psychological.
Let's dig into that psychology. What is stopping a brilliant Wall Street analyst from just admitting that the future has multiple possible outcomes?
The fear of looking weak.
Really? Just ego.
It's the culture. If a highly paid financial analyst goes to a demanding client and gives them a wide range of probabilities, openly admitting how uncertain the future of AI is, it is almost universally viewed as a sign of weakness or a lack of conviction. The culture demands alpha. So they make these highly specific, aggressive point estimates and present them as absolute truth to project confidence.
And that psychological trap leads to these dramatic binary models, like the ultimate worst-case scenario.
Yeah, exactly.
And Damodaran argues that modeling a true worst-case scenario is practically useless for decision-making. I mean, if you build a model where the entire economy collapses and unemployment hits 20%, it paralyzes you. No investment looks good in that environment.
It might generate clicks and shock value, but it doesn't actually give you any actionable steps to take today.
Precisely. That is why Damodaran introduces a much better mental model for evaluating all these wild AI claims. He calls it the 3P test.
I love this framework.
It's so useful. When you hear a scenario about the future of AI, you need to filter it through 3 distinct buckets. Is it possible? Is it plausible? And is it probable?
Let's define those buckets for you listening, because this is a tool you can use every day. First, possible just means it isn't a fairy tale. The laws of physics allow it. Citrini's rapid doomsday. Technically, it is possible.
Next is plausible. This raises the bar significantly. For a scenario to be plausible, there needs to be some historical precedent or some existing measurable data to back it up.
And finally, probable. This is the highest hurdle. A probable scenario means the data shows it is already happening, and based on current observable trajectories, it is the most likely outcome.
So think about the headlines you scrolled past this morning about AI taking over the world. Which bucket do you think the AI doomsday falls into? Do they pass the possible test, or are they actually probable?
This raises an important question, because to answer what is probable, we have to establish the framework of how AI disruption will actually unfold in the real world. Damodaran breaks it down into two core variables. First, will AI broadly displace workers entirely, or will it just act as a powerful tool for them to use?
The classic displacement versus tool debate.
Yes. And the second variable is speed. How quickly will this disruption happen? Are we talking months or decades?
To find the probable answer, we have to look past the Twitter hype and look at the data we have right now.
And we do have data. The Federal Reserve in St. Louis actively tracks AI adoption and its productivity effects. And while survey data can be a bit noisy, the trends are clear. AI adoption is definitely climbing, but it is not exponential yet. The curve hasn't suddenly gone vertical.
And here's a really surprising data point from that Fed research. People are actually using AI more in their personal lives than they are at work.
That is fascinating.
It tells you a lot about the friction inside large corporations. Plus, the time savings at work are currently quite modest. The highest reported time savings are in company management and technology roles. But even there, we're talking about marginal efficiency gains, not an overnight revolution.
Right. By combining those two variables, speed and displacement, Damodaran builds a disruption matrix. This helps visualize the future. In the top left quadrant, if you have speedy disruption combined with mass displacement, that is the Citrini doomsday scenario.
Imagine entire corporate legal departments wiped out in 18 months.
Exactly. Massive short-term benefits for AI companies, but catastrophic short-term costs for the broader economy due to rapid job losses.
Then you have the next quadrant, slow disruption with displacement. He calls this the delayed detonation. What does that look like in practice?
Think of the accounting industry. AI might not replace every CPA tomorrow, but over a 10-year period, the software slowly eats away at the entry-level auditing tasks. Firms stop hiring junior accountants. A decade later, firm sizes are slashed in half.
So the benefits grow slowly, and the devastating costs to the workforce are pushed into the future.
Correct. On the other end of the matrix, you have slow disruption, where AI acts purely as tools. This is the disruption fizzle.
Oh, fizzle.
Yeah, it has a very low macroeconomic impact. Microsoft Copilot just writes slightly better emails for us. We get faster spell check, but nothing fundamentally changes about the labor market.
So when we run this entire matrix through the 3P test, we arrive at the probable outcome.
The probable verdict is that disruption will certainly happen, but it will be highly uneven and localized. AI will completely displace workers in some specific businesses, and it will provide game-changing tools in other areas. But overall, the shift will be incremental, messy, and slow.
Which brings up a great point about human nature. One of the main reasons this disruption will be slow is simply human reluctance. People, especially older workers or those in established legacy industries, fiercely resist changing their daily habits.
Oh, absolutely. Plus, for all the magic of AI, it still has major hallucination glitches to work out before any sane CEO hands over total autonomy to a machine.
If we look at the history of the PC revolution or the dot-com boom, none of them happened in a straight, frictionless line. Humans are naturally resistant to paradigm shifts. AI will face those exact same cultural and psychological speed bumps.
So what does this all mean? Let's bring this down to the individual level. We need to talk about the vulnerability checklist.
Yeah, how do you, listening to this right now, evaluate your own career? Who is actually going to get hit first by AI displacement?
The prime targets for AI displacement share a few distinct characteristics. First, AI will aggressively target young companies with young employees.
See, that feels completely counterintuitive to me. You would assume ancient, bloated corporations would be the most vulnerable to a sleek new technology. What is the logic there?
It comes down to institutional inertia. Younger companies have significantly less bureaucracy. They're agile. A startup with 50 employees can decide on a Tuesday to replace a human workflow with an AI agent and implement it by Friday.
Oh, I see.
Yeah. A legacy corporation with 10,000 employees has compliance departments, HR protocols, and decades of red tape. Bureaucracy, ironically, acts as a temporary shield against rapid AI displacement.
That is fascinating. Bureaucracy as a moat. Okay, what about the types of work being done? Who is next on the target list?
Second are high gross margin businesses. If an industry has massive profit margins, AI startups are going to aggressively target it because there is so much excess profit to be captured by automating the work.
Right, follow the money.
Exactly. Third, and perhaps most obviously, are jobs built entirely on mechanical and rule-based tasks. But this leads to the most crucial differentiator Damodaran identifies: system protection.
Yes, system protection. This is the ultimate hidden shield against AI. Software engineering is highly vulnerable right now because it is entirely rule-based, and crucially, it has incredibly weak system protection.
There are no major regulatory moats, no government licensing boards stopping a tech startup from using an AI to write Python code.
Compare that to real estate appraisers or mergers and acquisitions bankers.
Right. By definition, their day-to-day jobs are incredibly mechanical and rule-based. They are essentially plugging numbers into fair value accounting models.
But they are highly protected.
Very protected. They are protected by courts of law, by rigid accounting rules, and by intense, well-funded lobbying efforts.
It's the ultimate reality check for the tech utopians.
Okay.
A CEO doesn't hire an M&A banker and pay them millions of dollars just to get a mathematical valuation. An AI can do that in 3 seconds.
Exactly. A CEO hires a banker for a fairness opinion to protect themselves from getting sued by shareholders in a court of law. And right now, a judge wants a human neck to wring if something goes wrong. A judge is not going to accept a fairness opinion generated by an algorithm.
Until the legal system fundamentally rewrites its rules, which takes decades, especially when human lobbyists fight back Haas, those jobs are protected by the system, not by the complexity of the task itself.
If we connect this to the bigger picture, we have to look at the unspoken toll this shift is going to take on society. Every major technological disruption of the last 40 years has consistently tilted the playing field toward massive corporations, worsening wealth and income inequality.
And there is a real profound psychological cost here that we rarely talk about on corporate balance sheets. Jobs aren't just a way to pay the mortgage. For many people, they are the very foundation of their self-esteem, their status, and their identity.
We are looking at a scenario where highly educated white-collar workers are about to face the exact same crushing psychic damage that blue-collar manufacturing workers faced during the massive automation and offshoring waves of the late 20th century.
It is a profound shock to the system to spend 20 years perfecting your specialized expertise, paying off massive student loans, only to be told that a piece of software can replicate your life's work for fractions of a penny.
Which brings us to one of the most fascinating and frankly slightly terrifying anecdotes from Damodaran's source material.
Oh, the Damodaran bot.
Yes, a colleague of his at NYU Stern essentially built a Damodaran bot. They took every video lecture he has ever recorded, every textbook he's written, every blog post he's published, and fed it all into a large language model to create a digital interactive clone of his brain.
Having an AI actively trying to replace you is quite the motivator.
It really is. To stay ahead of his own digital clone, Damodaran developed a 4-step survival guide. It is a practical strategy to outrun your digital replacement, and it is something everyone listening should evaluate their own habits against.
Step 1. Be a generalist. Be a dabbler. For the last 50 years, the global economy has fiercely rewarded hyper-specialization. If you are the absolute best at one tiny esoteric niche, you are safe and highly paid.
But now AI is the ultimate specialist. Your best defense is to move fluidly across different disciplines. Connect the dots that a highly specialized AI wouldn't even think to look at.
Step 2. Use both hemispheres of your brain.
Great.
Combine cold left brain logic with warm right brain storytelling.
AI is incredibly, undeniably good at logic and data processing, but if you can marry that analytical rigor with human empathy, nuance, and narrative, you become exponentially harder to replace.
Step 3. Flex your reasoning muscles. This is a big one for our daily habits. It is so easy right now to just open ChatGPT and ask for the answer to a complex problem.
But if you do that constantly, your cognitive muscles atrophy. You have to force yourself to practice the process of reasoning, to endure the struggle of figuring things out from scratch, so that you maintain your critical thinking skills when the bot inevitably makes a mistake.
And finally, step 4, which might be the most counterintuitive piece of advice in the modern working world. Maintain an idle mind.
I love this point. We live in a hustle culture that demands constant, measurable productivity. But letting your mind wander, having unstructured, idle time to daydream, is a uniquely human source of creativity.
It's the space where true disruptive innovation happens. An AI does not daydream. It only processes when it receives a prompt.
It's a vital reminder. We must fiercely protect our idle time. But of course, there is always the lingering, skeptical question, what if we do all this preparation? What if we become generalists? We practice reasoning, we adapt, and the AI revolution turns out to be a total fizzle.
What if it never really arrives the way they promise?
Yeah.
That is where Damodaran brings up a brilliant historical analogy to frame our thinking. Pascal's wager.
Blaise Pascal.
Right, the 17th century French mathematician who created a logical argument for believing in God. Pascal said, if you believe in God and God exists, you go to heaven, infinite upside. If you believe and God doesn't exist, you've lost very little.
But if you don't believe and God does exist, you go to hell, infinite downside.
Therefore, the expected value of believing is entirely positive. How does that translate to the AI debate?
We can apply the exact same mathematical logic to artificial intelligence. You should act right now as if AI is absolutely going to take your job. Assume the bot is coming for you.
Assume the worst.
Right. If you prepare by diversifying your skills and learning to leverage the technology and the disruption does come, you are ready to survive and adapt. But if you prepare and AI turns out to be a massive fizzle well, you haven't lost anything.
In fact, by broadening your skills and improving your reasoning, you have simply made yourself a much sharper, more dynamic, more capable professional.
The expected value of preparing for AI is completely positive, regardless of the outcome.
Exactly. It's a no-lose scenario for your personal development. Thank you so much for joining us on this deep dive. Keep asking hard questions, keep those reasoning muscles strong, and take a hard look at your own vulnerability checklist this week. We will see you next time, but before we go, I want to hand it over for one final thought to mull over.
We have spent this entire deep dive talking about AI driving hyper-efficiency and productivity. But if the most advanced technology in human history is being designed specifically to optimize every single second of our working lives, what if our greatest competitive advantage in the future is our ability to be intentionally inefficient? What if daydreaming, making mistakes, going down weird rabbit holes, and being wonderfully, uniquely unproductive is the only true moat human beings have left?